Today, the Bureau of Statistics said wages during 2023 grew 4.2%. That's the biggest wage rise since 2009, 14 years ago. And public sector wages, they're the highest in 15 years. Those who soared the biggest were increases in healthcare, up 5.5%, education and training, up 4.8%, and administration, up 4.5%, as well as retail. You can see there, up 4.3%. The government and Treasurer have urged for even higher wages as inflation took off. Let's hear whether that story changed now that wages growth has gone higher than inflation.
Get inflation to continue to moderate, wages to continue to grow, and to get these tax cuts flowing. We want to see real wages growth in a sustained and in a sustainable way. We're very pleased with this outcome today, but we know that there's more work to do.
So no change in the rhetoric. You can see he wants even higher wages. Sean Langcake is the head of Macroeconomic Forecasting at Oxford Economics and joins me from Adelaide. Sean, always good to chat to you. Is that realistic from the Treasurer, basically saying he wants even higher wages because ultimately those higher wages feed into inflation in this country?
Yeah, quite right. I think it is reasonable to expect that we get real wage growth on an ongoing basis this year, but that's more a function of the kind of incredible step down that we're seeing in goods price inflation as supply chains resolve overseas and that disinflation continues. What we need to kind of guard against and what the RBA will be looking at most closely is the outlook for services inflation because, as you rightly say, this wage growth has to go somewhere and it's far from mission accomplished in terms of taming inflation on the services side of the CPI basket.
Okay, so just think our way through this because we know that the Reserve Bank is still hedging its bets and saying, look, it may have to raise interest rates. Everybody anticipates the rates will fall later this year, but it is about the inflationary outcomes. It's therefore all about the domestic economy. It's about wages. It's about the services economy and whether inflation really has taken hold there in a big way. What's your own sense of that?
Look, I think what we've seen so far is a very, very fast disinflation, getting the CPI down from a rate that starts with a 7 to around 4% now. And that disinflation is ahead of schedule, and that's a really good thing. But it's going to be really protracted and really hard to get inflation from the current pace of 4% to 3%. Part of what's going on there is the rolling off of subsidies and the ongoing tightness in rental markets. But we really can't get away from labour costs here. So a WPI result with a 4 in front of it, coupled with pretty meagre or weak productivity outcomes, means strong unit labour cost growth. And it is going to really start and continue to boil away through 2024 and make it hard for inflation to find its way back down to 3%. I don't think we're going to see further rate hikes. I think a lot of that communication is about trying to set market expectations and get them to kind of discount the idea of rate cuts in the first half of the year, but it is going to be right until the back end of 2024 before we start to see rate cuts, I think.
Okay, I was going to ask you about that also because, some have got 3 rate cuts penciled in this year. My sense is if we get there, it might be one late. November's a pretty typical time they'd go. What's your own sense as to when they might be thinking about moving rates down for the first time?
Yeah, look, I think the kind of timing you're describing there is about right. And it's going to be one at best, in my view. I think any kind of ideas of 3 rate cuts, well, that might mean that things have panned out in a worse way than we expect. Really, we're not going to see inflation get below 3% until into next year, I don't think. The board's been kind of clear that they are prepared to cut rates before we get an inflation print that's below 3%. But I still think that it's going to be above the target range until the end of the year. And yeah, we'll be lucky to get one cut towards the back end of the year.
But even the people that you're advising, the businesses you're advising, they'll be telling you about rising costs right now. And if all of a sudden they've got wages that are growing faster than their own costs and the profits and the pricing that they can pass on, that means their profits are being squeezed. And that therefore leads to the prospect that they're going to have to cut even harder into their own cost bases.
Yeah, and look, the way that we see this kind of playing out over 2024 is a bit of a deterioration in labour market conditions. We do see the unemployment rate easing up to around 4.5% by the end of the year. I think some of the run up in the unemployment rate that we saw in January is going to be unwound. There were some statistical quirks in those data. But there's no question it's going to be a bit patchy through this year, and the labour market will deteriorate a little bit. The light that we have at the end of the tunnel a little bit is a bit of an easing in conditions. We've talked about monetary policy, but we will get a bit of respite in terms of a tax cut from the second half of the year, which will hopefully help shore up conditions a little bit.
Because I was thinking about that, if the unemployment rate runs up towards 4.5% very quickly, then with the new mandate that the Reserve Bank's got to not look just at inflation, but also the unemployment rate, that could, urge it or force it to move even sooner.
Yeah, and this is, I think, what I was trying to allude to before, where I'm kind of saying, well, be careful what you wish for in terms of these rate cuts, because, you want to be getting rate cuts for the right reason. Not some kind of emergency response to the unemployment rate spiking higher very quickly. So, look, I think the hope is that, the labour market easing in conditions remains orderly and kind of slow and gradual. But yeah, we can't discount the possibility that it doesn't play out that way.
Sean Langcake, always good to have you in the program. Many thanks for your time today.
My pleasure. Thank you.